Can you see my blankie? Oh shit! Get my blankie down.
I think you can see it underneath.
All right.
So last time Jeff was here, it was raining. And I swear the last 2 weeks it's been sun. And starting tomorrow it's gonna be sun again. But Jeff's here and we're under trees because it's raining.
I bring the rain. I bring the rain. I'm from Seattle. I bring the rain. That's what I do. You started talking about mortgage rates and finances, and I get all excited. My juices get flowing.
Okay, so I need you to be excited because I'm getting nervous. I'm hearing that the Federal Reserve might increase base rates throughout the end of the year. I think Bank of America said that they expect 3 rate increases through the end of 2026. Does that not frighten you? Because it frightens me. What does that mean? Like, does that mean interest rates for mortgages are going through the roof? What actually happens? How does that work?
Well, that actually is scary. I agree. I haven't heard that.
No,
about Bank of America.
I need you to help me get unscared.
Well, I'm going to help you get unscared. Here's where I think we're at. I think that there's a small chance that they'll increase rates. I feel like a lot of times they make these comments about rates to kind of scare the market back in some cases. I mean, we are definitely concerned about inflation. However, we just got a really good CPI, which is Consumer Price Index, showing inflation dropping, and then the producer
I saw that
price,
was just came out like a couple days ago, right?
Exactly.
Yeah.
Tuesday and Wednesday, back to back, we got some good inflation reports. We saw a good rally for the last couple of days in rates. A rally meaning that there's more excitement around the market. People are buying bonds, pushing rates down. But then, of course, we're going the other way today because there's more news coming out of Iran. Iran's threatening the U.S. that they're going to blow things up, and that can get chaos. So now rates are going back up. I think
we're doing the same thing, though, right? We're threatening the same.
Yeah, I know. It's that whole thing over there. We just need that to end. I mean, if we can get that over, I think we'll see rates start to normalize and start to head back down.
So let's say the Federal Reserve did increase the base rate.
Okay.
What does that do for mortgages? So let's say they're meeting at the end of this month, right?
Yeah.
Like in a week or so. So let's say they increase, well, I guess when this video comes out, it won't be a week or so, but let's say they increase the base rate. How does that directly or I guess indirectly affect mortgage rates?
I mean, it can indirectly affect mortgage rates. It's not necessarily a one-for-one.
They're not tied.
No, they're not tied. Really what we're tracking is the 10-year Treasury more than anything. But rates go up, there's going to be more fear in the market, and that could mean that bonds are going to go up in price. The reason bonds have to go up in price is because they need to be more attractive. Bonds are linked to inflation. So if the government's coming out...
How is a bond attractive? What does that mean?
So a bond's attractive because it's a guaranteed rate of return. You put your money in, the government is backing this financial vehicle and giving you 100% of your money back plus a guaranteed return, which is awesome.
So when you're saying the 10-year, is that talking about a 10-year bond then?
That's a 10-year Treasury. So yeah, it's a 10-year. You'd buy it today, you'd have to hold on to it for 10 years to get the full revenue of that return on that bond.
And so you're saying that is something that is somewhat tied to mortgage rates?
That is somewhat tied to mortgage rates. And the reason is think about this, the 10-year Treasury is one of the safest investments you can possibly buy. You put your money in and it's backed by the US government, so it's guaranteed to come back to you. Now, let's look at mortgages. Mortgages don't have that same guarantee. People could lose their house, they can go into foreclosure. There's more risk in the housing market. So because of that risk, we have to charge a higher rate on mortgages in order to make a better return so that people will buy those bonds. It's all about enticing investors to buy these. So
if the 10-year goes down in theory, the mortgage rates can go down in theory?
They should, and they usually track, and you usually have a margin between them. The margin is usually about 1.5 to 1.75% is the difference. So if the 10-year Treasury today is 4%, mortgage rate should be at like 5.5 to 5.75. So they'll be a little bit higher. And the reason that the mortgage rates track the 10-year Treasury is the average lifespan of an actual 30-year mortgage is only about 7 to 10 years. So because of that shorter
they're comparable.
They're comparable in time frame. So that is the big thing. So more people want to buy the 10-year Treasury because it's guaranteed, but it has a lower yield on it, a lower return. So the mortgages become more popular because they have a higher return, yet they have a little more risk, although I think the risk is pretty low. Nonetheless, that spread that we were talking about before is a little bigger right now. It's just over 2%. So we do still have a little bit of room.
So there's room that those rates could come down.
Mortgage rates could
so
come down.
even if the Fed does increase the base rate, which could affect the 10-year Treasury, is that how that works?
It can, yeah.
And then that means with that wiggle room you're talking about, maybe mortgage rates won't go up a lot.
Yeah, I mean, the big thing with the Feds increasing their rate, what that does is that is going to try to slow down the economy. The Feds would only raise rates if they thought inflation was a true fear out there and that they were worried about inflation getting a little more rampant. They would raise rates to kind of keep things in check. They feel like right now some of the comments I'm getting is that the jobs market is okay and that inflation is a concern, but it's based on the oil. You know, that's what this is all based on right now. If you go back about 3.5 months ago, rates were under 6% for the first time in, gosh, as long as I can remember, like 2023.
As long as you can remember.
Yeah, it's been too long.
Post-COVID days.
So they got to 5.75. The housing market kicked in, and then all of a sudden, I remember it because I woke up Monday morning and I'm like, what's going on?
I think everybody woke up Monday morning, that Monday morning.
Oh my gosh.
Wondering what happened.
And so we got into Iran and everyone flipped out. Gas prices are going up because of lack of supply and the Strait of Hormuz is blocked up. So that's really, our inflation is based on a short-term fix here though. So gas is the main reason that our inflation is higher. So again, if gasoline's only up to about $80 a barrel right now, is over $100, almost $110 a barrel back in the real day where rates are up there. So gas is hanging in there right now. It's not getting too scared. So I think their biggest concern right now they're keeping an eye on is gas prices and oil prices.
So maybe the Federal Reserve's not going to do anything rash at the end of this month because they're expecting that to be a shorter term issue.
I agree with that 100%. I believe that. I feel like the Feds are warning, making comments, but then they're changing their comments based on how they're how the market's
like the jobs
reacting.
report.
Exactly.
How much was it changed in 2025?
I don't know. It's kind of it's comical the way they do that. Now, what I do love about our situation right now is I love Kevin Warsh. I think he's coming in with a fresh mind, fresh for the first time in probably 50 years as a Fed governor, who really wants to look at today's data and make decisions based on today's data. Normally, historically, the Fed make decisions based on the last 12 months trailing. So they're always making rushed decisions at the last moment, and it's already gone too far. So they're reacting too slowly. Then they have to over-adjust, which is what happened back in 2021.
So that is a good point, though, that the reaction time from the Federal Reserve might be quicker than it has been in the past.
I think it's just going to react to actual data. And I think the actual data right now is not that as bad as everyone else is making it out to look like. I mean, unemployment is still calm, and if anything, it's probably worse than we think because a lot of those reports are year over year going back 12 months.
And some of those reports are based on people having like 3 jobs, and they're like, oh, we added 3 jobs. So it's like, well, that's not quite.
Well, and some of them too are job availability, job openings. A lot of times it's, a company posts a job in all 50 states because it's a remote job. Well, that one job opening gets posted 50 times, that adds up the numbers. So we get a lot of that kind of double counting and stuff.
I think I just felt the first rain. It is raining pretty good out here. These trees are really protecting
I feel
us.
protected.
It's not going to last much longer.
I think the good news, I think in my opinion, I don't think we'll see a rate hike. I mean, I'm hoping that's the case, and I'm thinking that's the case. I feel like based on today's information, even though, yes, I think gas prices are going to go up again, and we might see a little more inflation again over the next couple of months, because they're going to start looking at this information on a current basis rather than a past basis, that we'll have a good luck that they'll keep rates where they're at towards the end of the year. The big wild card in that is the Iran conflict. If we can get that resolved and get that a peace treaty or whatever, or just pull the heck out of there, I think that would be the game winner right there and make it happen. Yeah. We're definitely not doing that, unfortunately, but we just got to see what happens. But that is going to be the thing that could change the market dramatically and send rates lower pretty quickly.
Thank you for talking about rates with me.
Yeah, you're welcome. I like talking about this kind of stuff. It's fun.
You get excited.
Math is fun.